Hello students and welcome to this Finance for Engineers course. In earlier lecture, we started fourth unit concerning to investment decision tool where we discussed about how important investment decision is, what different steps finance team has to take while taking investment decision, which is also called as capital budgeting decision. Also, we discussed about the various techniques used for evaluating capital budgeting proposals or projects. Two techniques we have discussed. That is, first one is non-discounted cash flow criteria, and the second one is discounted cash flow criteria. Under these criteria, again, different techniques are there, methods are there, which are used by the business organizations for evaluating investment decisions. Under non-discounted cash flow criteria, first is payback method and second is accounting rate of return method. Then the discounted cash flow criteria comprises of three techniques. First is net present value method, then profitability index method, and internal rate of return method. Here we try to understand what is the time value of money and how it affects on the investment decision. Also, in last lecture, we have started with first technique, that is payback method technique of evaluating investment proposal. Now we are going to discuss about the second technique, which comes under non-discounted cash flow criteria, that is accounting rate of return, which is also called as average rate of return method, that is ARR. Accounting rate of return is the average net income an asset is expected to generate divided by its average capital cost, and it is expressed as an annual percentage. These typically include situations where companies are deciding on whether or not to proceed with a specific investment, that can be a project or an acquisition, etc. Formula for calculating accounting rate of return is equal to, into bracket, average annual profit after tax divided by average investment into 100. As it is calculated in a percentage, we have to multiply it by 100. So now how to calculate average investment? Average investment is equal to original investment divided by 2. Let us see an example. Rita Private Limited, Pune, is considering an investment proposal to install new milling control at a cost of rupees 50,000. The facility has a life expectancy of 5 years and there is no salvage value. The tax rate is 35%. Assume the firm uses straight line depreciation and the same is allowed for tax purposes. The estimated cash flow before depreciation and tax from the investment proposal are as follows. Here you can see 5-year data is given concerned with cash inflow, and you are required to compute accounting rate of return for the above mentioned proposal. So this is the information where they have given us idea about the investment amount, that is rupees 50,000. Then life of an asset 5 years, tax rate 35%, and the method used for calculating depreciation is straight line method. Now, on the basis of this information, we will see how to calculate accounting rate of return. So let us see the solution. Again, we have to prepare a statement, but this statement is something different than the earlier one, that is which we have prepared in a payback method. Here you can see a title, statement showing cash flow after tax. Here we are not going to add back depreciation. So let us see. You can see here particulars and 5-year column. Cash flow before tax already given in the problem. The same information we have carried here. Less depreciation. Now you know how to calculate depreciation. That is cost minus salvage value divided by life of an asset. So 50,000 cost is given, no salvage value, and life is 5 years. So by this way, we calculated depreciation, and straight line method is used by the organization. So 10,000, we are writing this for all the 5 years. Then after deducting depreciation from cash flow, we get profit before tax, and on that figure, we calculate tax at the rate 35%, and that calculated tax figure we deduct from PBT, and we arrive at profit after tax, which is also called as PAT, or we can say cash flow after tax. So here you can see we are not adding back depreciation. That means this method is exceptional, where we are not adding back depreciation. And on this figure, we are going to calculate ARR. So let us apply a formula and see what is the ARR for this particular project. So you can see here average annual cash inflow, that is all the 5 years cash inflow is written, divided by 5 years. Then again it has got divided by average investment. What is the formula for average investment? Original investment divided by 2 into 100. And this will give you ARR is equal to 9%. So 9% is the accounting rate of return of this project. Now, they have not given information concerned with predetermined ARR by the firm. So it depends on the organization whether to accept this particular project or proposal or to reject. Actually, 9% is very less rate of return. So generally speaking, the firm should reject the proposal as it is very less amount it is giving us as a return in percentage. Now let us see the next example. XYZ company is looking to invest in some new machinery to replace its current malfunctioning one. The new machine, which costs rupees 4,20,000, would increase annual revenue by rupees 2 lakh and annual expenses by rupees 50,000. The machine is estimated to have a useful life of 12 years and zero salvage value. So this is the basic information they have given concern with a particular machinery, and you are required to calculate accounting rate of return of the new machinery. Now here, they have not given year-wise data related to cash inflow. That means the same amount may get repeated every year. That means the same 2 lakh rupees every year the firm can earn from this particular machinery. This is an estimation. And at the same time, annual expense is rupees 50,000 every year they have to spend on this machine. And the life is given 12 years with zero salvage value. So let us start with solution. In this case, we will calculate average annual profit of the machinery. So 2 columns, particulars and amount. As the same figure we will get at the end of every year, we have written into bracket year 1 to 12. So what is inflow? That is nothing but a earning. So it is 2 lakh rupees into 12. So 24 lakh total amount we can earn from this machinery, less annual expenses 50,000 into 12. So for 12 years, we have to spend 6 lakh rupees, less depreciation. So first I have calculated depreciation, that is cost minus salvage divided by life. Then we arrive at 35,000 into 12 will give you 4 lakh 20,000. So we arrive at total profit 13 lakh 80,000, which is the total of all the 12 years profit. Now next, we will see average investment. Total investment is 4 lakh 20,000. There is no installation expenses and all. So total investment we can say 4 lakh 20,000 divided by 2. So average investment here is 2 lakh 10,000. Next, now we will calculate average annual profit. Already we have calculated total profit for 12 years. So 13 lakh 80,000 divided by 12. So annual profit is rupees 1 lakh 15,000, and by applying formula of ARR, we get the rate of return is 54.76%. Now here it is a good percentage. So company, the organization can accept the proposal. The company can invest in this particular machinery as it is giving good rate of return, that is 54.76%. So in this way, we can calculate for a particular machinery. Now the next is, this is the data where we have machine A and machine B, and we have to calculate ARR as well as payback period for both the machines. And as these are mutually exclusive, we have to suggest the organization which one is profitable to the organization, which machine the firm should accept or purchase. So let us see what information they have given concerned with both the machine. First is cost. Cost of both the machine is same, rupees 56,125. Next information is concerned with annual estimated income after depreciation and income tax. That means this is the income where they have already deducted depreciation and tax. And we can see here for machine A, 5 years cash inflow is given. For machine B, again 5-year data is given. Next is estimated life in years. Both machine have 5 years life, and estimated salvage value of both the machine is again same, that is rupees 3,000. So let us start with calculating first payback period of machine A. Then we will calculate accounting rate of return of machine A, and then machine B payback period and accounting rate of return. So let us start with solution. So for machine A, first we will prepare a statement showing cash flow after tax before depreciation. So in example, what they have given to us, they have given cash flow after tax and depreciation. That means both they have deducted. And now we have to add back depreciation, because for calculating payback period, we need to calculate depreciation amount and we have to add back into the cash flow. You can see here, statement started with profit after tax, 5 years information written, then add depreciation by using formula of depreciation, calculated depreciation, and the amount of depreciation arrived is 10,625. There is no information given concerned with the method of depreciation used by the firm. So we assume that it is a straight line method, and the same amount we will write for all the 5 years. And then after adding that, we arrive at cash flow after tax before depreciation. And now next thing to do is preparing a cumulative for calculating payback period. So statement showing cumulative cash flow after tax, and this is the statement where you can see vertically presented year, cash flow after tax, and cumulative of cash flow after tax. Why we prepare this cumulative? Because it helps us to understand where the payback period lies between, that means between the 2 years. So you can see here, as the amount of investment is more than 50,000, we can see here at the end of third year, we receive 49,600, and at the fourth year, it is 70,100. That means the payback period must be lying in between the third and fourth year. So now let us apply the formula of payback period. So here you can see 3 plus 56, 125 is the initial cost minus 49, 600, which we are getting at the end of third year, divided by the 20,500, the amount which we get at the end of fourth year as an annual income. It is an annual income of fourth year we have written, and thus we get payback period of this particular machine A is 3.318 years. So here we have calculated payback period. Now let us calculate average rate of return or accounting rate of return. So for that, first we will write a formula, that is average annual profit after tax divided by average investment into 100. Now we have information with us concerned with PAT, which is already given in an example. As we have discussed earlier, that in this particular method, we never add back depreciation. So this amount is given in original example, which is after depreciation and tax. So that I have taken here for calculating average annual profit after tax. So divided by 5 years is equal to, the amount is 7875, that is 7,000. 875 is the annual profit, average annual profit. Next, we have to calculate average investment. The amount of investment given is 56,125 divided by 2 is equal to 28,062.5. Now calculate ARR. It is 28.06% for machine A. Now we have applied both the techniques for evaluating machine A proposal. Now same steps we will follow for machine B. Okay, so let us see for machine B, statement showing cash flow after tax before depreciation. Same thing we have repeated here. Written profit after tax figure, which is given in an example. Then calculated depreciation and added into the PAT, and thus we received cash flow after tax. Then we prepared a vertical cumulative cash flow statement for identifying the payback period of the machine B. So here we can see at the end of second year, we are getting 43,500, and at the end of third year, we are getting 61,500. That means the payback period must be lying in between the second and third year. So let us apply a formula. Payback period is equal to 2 plus 56,125, which is an original investment or initial investment, we can say, minus 43,500, that is the cumulative amount which we are getting at the end of second year, divided by annual cash flow of third year, that is 18,000. And by applying this formula, we get the payback period as 2.70 years. That means when compared with machine A, payback period of machine B is less. Okay, by payback method, we can say that machine B is profitable to the business. Now, let us see what is the result of ARR method. Again, we are applying formula for calculating ARR of this particular machine. You can see here the average annual profit after tax figure is same as of machine A, 7875. Then average investment, again the same amount we are arriving at, that is 28,062.5, and therefore average rate of return of machine B is also as same as machine A, that is 28.06%. Now here the company is expecting suggestions from you people that which machine they should acquire, and now you have applied both the techniques, that is payback and ARR, for uh, both the proposals or projects machines A and machine B. Payback period of machine A is more than the machine B. ARR for both the machines is same, that is 28.06%. So on the basis of payback method, we can suggest the organization to accept proposal B. Why we are suggesting machine B to the firm? Because the payback period of machine B is less than the machine A. Therefore, firm should purchase or acquire machine B when compared with machine A. So this is the suggestion we can give to the organization. Now, let us move ahead. Next is discounted cash flow criteria. Under that, first is net present value method. This is one of the widely used method for evaluating capital investment proposals. Why this is used widely? Because in this particular technique, the cash flow that is expected at different period of time is discounted at a particular rate. That means it give importance, significance to time value of money. The present value of cash inflow are compared to the original investment. It should be found out by subtracting present value of cash outflows from present value of cash inflows. So the formula used for net present value can be written as follows. So this is the formula used for calculating net present value. Now in square bracket you can see C1 divided by into bracket 1 plus K plus C2 divided by into bracket 1 plus K square. So like this we will calculate cash inflow, that is the present value of cash inflow, minus CO. So where C1, C2 represent cash inflow, then K is the firm's cost of capital, CO is the cost of investment proposal, that is nothing but initial investment, and N is the expected life of the proposal. It should be noted that the cost of capital, that is K, is assumed to be known. Otherwise, the net present value cannot be known. We cannot calculate net present value of a particular proposal if we don't have an idea about cost of capital. So in other way, we can write NPV is equal to PVB minus PVC, where PVB is present value of benefit and PVC is present value of cost. Now, here, what is the accept reject criteria used? We will accept the proposal if the project is giving net present value positive, and we will reject the proposal or project when NPV is negative, that is less than 0. Or the firm may accept the proposal when NPV is equal to 0. So it depends on the organization whether to accept it or reject it if it is equal to 0. So this is the criteria used for accepting or rejecting any proposal project by using net present value method. So here I am ending my session now, and in next session we will continue examples on the remaining technique, that is net present value method, profitability index method, and internal rate of return method. Thank you.